Wars don't determine gold, but wars do influence the Fed at this particular position in time where they can't afford to have government funding be a problem. Okay. March of 2022 wasn't a problem. Now it's a problem because of high yields on bonds. So that war event now, compared to the Russia war, which again started late February of 2022. Okay, commodities peaked a couple of weeks later, so did gold. Okay, this time it's different. This time the war event is correlated to a point of pain for government debt, one that is emergency status. And I think the Fed is now positioned to, one, stop, though they won't admit it, and act behind the scenes to defend their market at all costs.
From Momentum Structural Analysis, MichaelOliver provides insights into how geopolitical events and monetary policy influence the financial markets, particularly impacting assets like gold and bonds. As investors closely monitor these factors in the coming months, they are eager to understand how the Federal Reserve's actions may affect the financial sector and gold prices. Historical instances where major geopolitical events, such as the First Gulf War in 1990, the September 11th, 2001 attacks, and rumors of U.S. intervention in Syria in 2014, have led to significant surges in gold prices. These historical precedents highlight the role of gold as a safe haven asset during times of uncertainty. In the current economic landscape, the Federal Reserve adjusts the money supply to stimulate growth during economic downturns and contracts the money supply to counteract inflationary pressures. However, MichaelOliver notes that the Federal Reserve has shifted its approach to managing the economy, influencing gold prices. Gold and U.S. Treasuries are typically considered safe haven assets. When bond yields decline, gold becomes more attractive, creating a strong positive correlation between bond and gold prices. Michael's assertion suggests that gold has recently increased its value while bond prices have declined. This situation may be attributed to the Federal Reserve's measures to support the economy during these uncertain times. Federal Reserve officials have expressed caution about the outlook for the U.S. economy, indicating that they will proceed carefully when deciding whether to raise their benchmark interest rate further. As gold prices reach one-month highs amid concerns about escalating regional conflicts, MichaelOliver believes that gold will continue to rise and bond prices may also experience an upswing. He emphasizes that it's not solely about the war, but also the Federal Reserve's responses to economic challenges. Before diving into MichaelOliver's insightful interview, subscribe to our channel and give this video a big thumbs up.
A lot of people think, oh my God, it did it only because of war. And we know back in March of 2022, when anybody bought gold then, of course, it had been going up for a long time.
Yeah.
March of 2022, technically gold was ripe for an intermediate decline. It turned out to be a sharp decline to the September 2022 low. We took out all the previous price lows of the last 2 years and immediately exploded again.
Yeah.
This time it's different. We have a war event, but we're in a different situation in terms of the Fed. Back then, they were starting their rate policy increases, March of 2022.
Yep.
Gold was technically ripe for a pullback, and it did. Okay. So did T-bonds. They turned down then too. We think there's a good technical linkage now, and this is not always true over history. In fact, it's quite often the opposite, between T-bond prices and gold prices. They're moving the same. Now, recently, T-bonds have crashed to the downside since highs when, like you said, earlier this year. So is gold. Gold's come down, but not crashed. It didn't even get back in the middle of its range hardly of the past couple of years. Now it ran back up into the 1900s again. Technically, you can almost overlay a momentum chart of weekly action of gold and a weekly action of TLT, and they're almost the same market. TLT right now, I think, is about 1 week behind gold. Gold last week broke out by our metrics, monthly momentum, of its corrective process that's been underway since March, April. Quite a few months of corrective process, most of it overlapping with that stinger we had a couple of weeks ago, went down to the low 1800s. But then we right back up mid 1900s. Okay. That was a fake out. That last drop was the end. Last Monday's close, which was like 1860, we said, that's it. You've aborted the momentum decline. You're now headed up, and you'll probably zap through the mid-1900s quickly. Well, we did. Now, some people will say it's only because of the Israel situation. No. Wars don't determine gold, but wars do influence the Fed at this particular position in time where they can't afford to have government funding be a problem. Okay. March of 2022 wasn't a problem. Now it's a problem because of high yields on bonds. So that war event now, compared to the Russia war, which again started late February of 2022. Okay, commodities peaked a couple of weeks later, so did gold. Okay, this time it's different. This time the war event is correlated to a point of pain for government debt, one that is emergency status. And I think the Fed is now positioned to, one, stop, though they won't admit it, and act behind the scenes to defend their market at all costs. And I think you're going to see that evidence. I suspect you'll see T-bonds start to rally now, probably sharply. A short covering rally. Yeah. Those can be very painful for the late shorts. You know, it can skewer them very well. And anybody who got late short bonds, like in this recent drop, is getting in very late as far as we're concerned. And they're likely to be skewered. And I think that will be coincident with gold surging back to and through its highs.
In the latest remarks by Thomas Barkin, president of the Federal Reserve Bank of Richmond, it's clear that the U.S. central bank is in no rush to decide its next move on interest rates. Anecdotal information suggests an economy slowing down, accompanied by a moderation in inflation pressures. On the other hand, Michael believes that the Federal Reserve is currently facing a challenging dilemma. On one hand, it cannot afford to let the bond market crash, as happened last year. This predicament could potentially force the Fed into a policy shift. The upcoming speech by Fed Chair Jerome Powell later in the week is highly anticipated, as it could provide valuable insights into future interest rate decisions. Let's get back to the interview.
Well, if you make a decision, financial decision, whether you're a family going to build a home, buy some property, or you're a farmer going to expand your farming capacity, or you're a company building another factory, hiring more employees, a lot of the underlying decision that you rely on, what are the factors you rely on, is the cost of money. Okay, it's a huge brick in your thought process. If that's delusional, falsely priced by the central bank to generate the boom they wanted to generate, and boy, they did. 7-fold move in the S&P, 16 in NASDAQ. Bonds went up big through 2020. But then when they pulled the plug, the cadaver, it's not a cadaver yet, but it will be soon, started to kick because you cut off its supply of free money. Yeah. So 12 years of addiction of a false concept built into your decision-making processes and your financial commitments, and suddenly it's ripped away. Reality hits you. So we strongly suspect you're going to see an exposure of events, developments that they're not the data points you look at. These are things that are going to happen because of what has happened, not because what's going to happen. Okay, so what the Fed does today or doesn't do, they're chasing reality. And right now, we think that with the crash in the bond market, remember last October, the bond market came down hard along with the stock market and so forth, T-bond market. Price went down, yield went up, okay. Then bonds had a big rally. Now they rolled over in recent months and blew out the low of last October, meaning yields went to a higher high. Everybody's bearish, long-term rates are going up forever. No, we're talking about U.S. government debt market here. We're talking about something the Fed cannot allow to get out of hand.
Right.
It got out of hand. Okay, so any talk of further Fed tightening, looking at data points to justify that baloney. It's their bond market crashed. I'm sure Yellen has talked to Powell about this, that she is disturbed by the illiquidity in the bond market. So Fed policy is going to change. What market knows this? Why has it behaved as it has behaved for the last several years? The gold market. The bond market collapsed 32% last year, just year over year. S&P down 22%, NASDAQ 100 down like 30-something percent. Gold had an unchanged year last year. 2022 close versus 2021. And gold's now back up hovering around its highs.
Yeah.
Okay. Why? If the Fed's going to kill inflation, quote unquote, you think, well, gold would be a victim, right? No, because gold knows what we just talked about. There's a major hangover coming.
Yeah.
Major regurgitation of error.
Michael further emphasizes that raising interest rates would be a measure to combat inflation, but it could adversely affect the gold market. Gold prices are holding firm because they reflect concerns arising from the central bank's past actions, which adds an exciting layer to the relationship between monetary policy, inflation, and the precious metal. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.